Q company has to pay to Q company. That is, Q company has to pay to P company. P becomes the creditor, Q becomes the debtor. When they becomes one and the same, if the goodwill is more, it will come on the asset side of the balance sheet. If the capital reserve is more, it will come on the liability side of the balance sheet. At the time of acquisition, there is undistributed profit is 20,000, undistributed reserve is 40,000. Hello, my dear student. I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. We'll move on to problem now. So this is a problem, fifth problem we are doing. From the following information, you are required to prepare a consolidated balance sheet, means the combined balance sheet of P Limited and the Q Limited, and is Q Limited as on 31st March 2007, means the year starts from 1/4/2006 to 31/3/2007. So balance sheet is given. The balance sheet of P company is also given. The balance sheet of Q company is also given. So here invested in Q companies 3,60,000 is there. Here come back. What's the share value? 100 rupees, 4 lakh is there. See, capital reserve, general reserve, secure loan, unsecured loan, then stock credit. See that the BP bills payable of Q Limited includes 3,000 due to P company. Means before the consolidation or before going to one and the same, who has to pay? Q company has to pay to Q company. That is, Q company has to pay to P company. P becomes the creditor, Q becomes the debtor. When they becomes one and the same, the question of BR and BP does not arise at all because they are one and the same. Then what to do now in the balance sheet? Add BP, deduct 30,000, add BR, deduct 30,000. So there is no question of BR and BP arises when they are consolidated. Before that, they are the debtors and creditor. Now the question of BR and BP does not come. Then creditors of K Limited includes 50,000 due to Q company. Sundry credit of P company limited includes 50,000 due to Q. Who has to pay? P company has to pay to Q company 50,000 before the consolidation. Now, when they becomes one and the same, the question of debtors and creditor does not arise. Add both the debtor, deduct mutual adjustment, add both the creditor, deduct the mutual adjustment. That's all. Then, at the time of acquisition of share by P company, and its holding in Q company later had undistributed profit and reserve amounted to rupees 20,000 and 40,000. We mean to say that at the time of acquisition, there is undistributed profit is 20,000, undistributed reserve is 40,000 is are there. Here, share capital Q company is 4 lakh is there. Then, divided by 100 each, ratio, number of shares, (4 lakh) divided by 100 rupees per share. If you cancel, 4,000 shares. So 4,000 shares, 4,000 shares, 3,000 shares acquired by P Limited. The balance (1,000 shares). Totally 4,000 share, 3,000 shares acquired by P Limited. The balance 1,000 share goes to minority, that is Q Limited. So ratio 3,000 is to 1000. 3000 is to 1000. Cancel the 0. They are in the ratio of 3 is to 1. This is the first step to do. The total number of shares Q Limited is 4 lakh divided by 100 is 4000 share. Out of the 4000 share, 3000 share acquired by P Limited. The balance 1000 share goes in favor of Q Limited. So they are in the ratio of 3000 is to 1000. Then regarding the profit, here undistributed profit is 20,000. At the end of the year, profit is surplus is nothing but profit. Surplus is nothing, 50,000 is there. At the time of acquisition, how much is there? 20,000. Total profit before that, shares, totally we have got 4,000 share, 3,000 acquired by P Limited, 1,000 share goes to, so 1,000 into 100, it is 1 lakh. Now, profit, that is nothing but surplus. What's the profit? You got 50,000. Minus capital profit 20,000, balance is 30,000. This is revenue profit. So what is the total profit? 50,000. At the time of it, 20,000. Divide 3 by, this is the ratio of 3 is to 1. 3 by 4, they are in the ratio 3. So 20,000 into 3 divided by 4, 15,000, 5,000. So divide the 30,000, 3 by 4, 30,000 into 3 divided by 4, 22,500. So 1 by 4 means 7,500. So divided. Then general reserve, total general as per the balance sheet. General reserve as per the balance sheet. General reserve is there. It is 1 lakh minus capital reserve available at the time of acquisition. Capital reserve is at the time of acquisition. See that 40,000 is there. Balance is 60,000. It is called revenue reserve. Divide in the ratio of 3 is to 1, 3 by 4. 3 by 4 of 40,000 is 30,000 goes to in favor of P company. 10,000 goes in favor of Q company. Divide 60,000, 3 by 4 means 45,000 goes to P company. 15,000 goes to totally. Add. This is 1 lakh plus 12,500 plus 25,000. 1,37,500 is called minority interest. So this will come on the liability side of the balance sheet. So 1,05,000 shared 7,000, total it will come 1,37,500. Then you'll find out the goodwill or capital reserve. What's your cost of investment? See that. How much they paid? Here, they paid how much? 3,60,000. Cost of investment, 3,60,000. Your face value of the share is 3,000 share they have taken at rupees 100 each. It is 3 lakh. Exercise, new goodwill are 60,000. Now, existing goodwill, see that what are the existing goodwills are there? Your existing goodwill 2 lakh plus 1 lakh 10,000 existing goodwill. Here 2 lakh plus 1 lakh 10,000. It is 3 lakh 10,000. This become 3 lakh 70,000 minus capital profit. How much capital profit is available? Your capital profit is, this is 15,001. Another capital reserve is how much? 30,000. Come back here. Your capital profit is 15,000. Your capital reserve is 30,000. Totally 45,000. Deduct 3,70,000. 3 lakh minus 45,000. 3,25,000. So this is no dividend. So dividend is nil. So once again 3,25,000. So this will appear on the balance sheet asset side. Whatever the law says, no, either the goodwill or the capital reserve, whichever is more, should appear on the balance sheet. If the goodwill is more, it will come on the asset side of the balance sheet. If the reserve is more, capital reserve is more, it will come on the liability side of the balance sheet. If you see here, no, your cost of investment is 3,60,000 for how many share? 3,000 share. What's the real value? Only 3 lakh. How much excess is there? 60,000. Already existing goodwill. You got 2 lakh plus 1 lakh, 3 lakh 10,000. If you add, become 3 lakh 70,000. Capital profit as per working note is 15,000. Capital reserve is 30,000. Totally become 45,000. If we deduct this, no, it is 3 lakh 25,000. There is no dividend at all. So the goodwill in the assets balance sheet asset side, how much will come? 3,25,000. So this will come on the asset side of the balance sheet. Then we'll move on to balance sheet. Slowly we'll move on to balance sheet now. Share capital. See the balance sheet. What is the share capital? Share capital P Limited is 8 lakh. Share capital P Limited 8 lakh. Then general reserve of P Limited, see the balance sheet. General reserve is how much? 1,40,000. 1,40,000. Then how much revenue reserve is there in the working note? See that. What's the revenue reserve? Here 60. Occupied how many here? 45,000. It becomes 1,85,000. Then you got a capital reserve in the balance sheet. See that. What's the capital reserve you got? 1,50,000. Then profit and loss, nothing but a surplus as per the balance sheet. Your surplus is how much is there? 2,60,000. Profit surplus 2,60,000. Add revenue profit as per the working note. Capital profit is there. What's say? Revenue profit is there. 22,500. 22,500. it becomes 2,82,500. Then minority interest 1,37,500. This is minority interest long-term loan. Here, secure loan. How much secure loan is there? See that working balance sheet. How much secure loan? 2 lakh is 2 lakh. How much unsecured loan? 1 lakh. So as per the balance sheet, share capital P limit is 8 lakh. General reserve is 1,40,000. Add revenue reserve 40, it become 1,85,000. Capital reserve is 1,50,000. Profit and loss account 2,60,000 plus revenue profit 22,500. It become 2,82,500. Then minority interest is 1,37,500. As per the balance sheet, secure loan is 2 lakh. Unsecured loan is 1 lakh. Both should be combined together. Then next is you go to current liability creditor. See that P creditor of P 1,50,000 plus 60 creditor 1,50,000 plus 60. Then minus mutual in the adjustment. Creditor includes, see that adjustment here on the date of purchase. Creditor includes how much here? 50,000. Mutual adjustment minus 50,000. So 2,50,000 gone means 1,60,000. Then come back to BP, bills accepted, BP. Here how much BP is there? Bills accepted. See that how much BP is there? 1,40,000 minus mutual. Here mutual adjustment BP is 30,000. Your BP accepted is 1,40,000 minus mutual 30,000. It become 1,10,000. So this is your total. So make the total 8 lakh plus 1,85,000 plus 1,50,000 followed by 30123 plus 2,82,500 plus 1,37,500 plus 1,60,000 plus 1 lakh 21,25,000. 21,25,000. This is total of the liability side. This is your total. 1,40,000 minus mutual 1 lakh. 21,25,000. Go with the asset side. Building balance sheet. 2 lakh plus 1 lakh. P 2 lakh. This is 1 lakh. It becomes 3 lakh. Then machinery 5 lakh plus 2,50,000. Machinery 5 lakh plus 2,50,000. 7,50,000. Then Goodwill P company 2 lakh. Goodwill 2 lakh. 1,10,000. Then new Goodwill existing 3,25,000. So present Goodwill 2 lakh plus 1,10,000 plus new Goodwill 3,25,000. Add, this is 2 plus 3, 6,35,000. no investment. Next one, if we go through the current liability, so you have to see the balance sheet and do the problem now. We'll go with the creditor. Creditor 1,50,000 plus 60,000. Creditor P 1,50,000 plus 60,000. Creditor minus mutual adjustment is 50,000. So 50 gone. 2,10,000. This is 1,50,000 plus 50,000 gone. It is 2,10,000 means this is, once again we see that how much is available. Greater 1,50,000 plus 60,000, 2,10,000 minus mutual adjustment. Your mutual adjustment is 50,000. So 1,50,000, 50 gone means 1,60,000. Then bills accepted. See the bills accepted. How much bills accepted is there? 1 lakh plus 40,000. Mutual adjustment is your mutual adjustment on the data. BP is 30,000. 1 lakh plus 1 lakh 40,000. BP 1 lakh 40,000 minus 30,000. It will come 1 lakh 10,000. Then come back. So make the total of this. So total will be tally for 21 lakh 25,000. Come back to the asset side. Building is 2 lakh plus 1 lakh 3 lakh. 2 lakh plus 1 lakh. It becomes 3 lakh. Then machinery 5 lakh plus 2 lakh 50,000. Machinery 5 lakh plus 2 lakh 50,000. This is 7 lakh 50,000. Then Goodwill P, come back to Goodwill. See that how much Goodwill is there. Old Goodwill is 2 lakh plus 1 lakh 10,000. 2 lakh plus 1 lakh 10,000 plus new Goodwill is 15,000. So this is 3 lakh 25,000. So how the Goodwill has been arrived, I've already shown you. The cost of investment is 3,60,000 minus face value. It will come 3 lakh. Excess is 60,000 minus capital, profit and capital reserve. Work out 45,000. So this is your 15,000 Goodwill. So 2 lakh, 3 lakh 10,000, 3 lakh 25,000. Then no investment. Stock. Look after the stock. Stock 1 lakh 20 plus 90. 1 lakh 20 plus 90,000. It comes to 2 lakh 10,000. Then come back to debtors. Debtors 1 lakh 50 plus 1 lakh. 1 lakh 50 plus 1 lakh. Mutual adjustment is 50,000. So 50, it is become 2 lakh. Then cash at bank 1 lakh 70 plus 50. 1 lakh 70 plus 50,000. 2 lakh 20,000. Then bills BR 1 lakh 50,000. Bank 1 lakh plus 50,000. 1 lakh 50,000. Come back here. 3 lakh. So this is 10 lakh 50,000 plus 3 lakh 25,000. 2 lakh 10,000. plus 2 lakh plus 2,20,000 plus 1,50,000. This is 3 lakh, 7,50,000, 10 lakh, 50,000, 1050 followed with plus 3,25,000, 2,10,000, 210 plus 2 lakh plus 1,70, 2,20,000 plus 21 lakh, 2,10,000, debtor 1 lakh 51 lakh. This is 2 lakh. Cash at bank 1 lakh plus 50, 2,20,000. BR 1 lakh plus 1,50,000 minus mutual 30,000. This is 1,20,000. If we add the figure, this is 1,20,000 plus 2,20,000 plus 2 lakh plus 2,10,000, 7,50,000 plus 10 lakh 50,000 plus 3 lakh 25,000. It will tally for 21 lakh 25,000. So I will repeat. The current as a stock is, if you go with the current liability, P is 1,50,000, Q is 60,000, minus mutual adjustment 50, it become 1,60,000. If we add both the BP, is 1,40,000 minus mutual 30,000, it is 1,10,000. It will tally for 21,25,000. Regarding the building, 2 lakh plus 1 lakh is 3 lakh. Machinery 5 lakh plus 2 lakh is 7,50,000. 5 lakh plus 2 lakh 50 is 7,50,000. Goodwill 2 lakh, 1,10,000 plus 15,000 is the new goodwill. It becomes 3 lakh 25,000. Stock 1 lakh 20, 92 lakh 10,000. Debtor 1 lakh 50 plus 1 lakh minus mutual 50,000. It becomes 2 lakh. Bank 1 lakh 70 plus 2 lakh 20. BR 1 lakh plus 50 minus mutual 30,000 lakh. So it will tally for 21 lakh 25,000. I hope I have gone through very detailedly. And in the last session, we did about the dividend. This is all the detailedly we had done. Whatever the profit available before acquisition is capital profit. Whatever the profit available after acquisition is called post-acquisition profit. Whatever the reserve available before acquisition is called capital reserve. After acquisition is revenue reserve. So if they pay more than the cost price, it's called the goodwill. In the balance sheet, either the goodwill or the capital reserve, whichever is more should be available. That's the most important. Hope you understand it. We'll meet with another session with a good problem. Till then, goodbye. Meet in the next class.